Every trader at some point has made the F it trade. You know exactly what I'm talking about. You're down big, emotions boiling, discipline out the window, and you just slam into another position thinking, F it, I'll make it back in one shot. And in that moment, you're no longer trading the market. You're trading your emotions. I've been trading for over 7 years, and I can tell you that I've seen more accounts destroyed by the single moment of weakness than any market crash, any black swan event, or any technical failure. The F it trade is the silent killer of trading careers. Today, I want to show you why the F it trade is the most dangerous decision you'll ever make in your trading career. We'll dive deep into the neuroscience behind why this happens, examine real stories of legendary traders who've fallen victim to it, and more importantly, I'm going to give you a complete system to rewire your brain so it never happens again. But first, let me ask you something. Have you ever found yourself staring at your screen after a loss, heart racing, jaw clenched, that little voice in your head whispering, just one more trade to get even? If you're nodding right now, this video might just save your trading career. Before we dive into the stories, let's understand what the F it trade really is. It's not just a bad trade, it's a complete breakdown of your trading system. Here's what happens in sequence. Phase 1, the initial loss. You take a normal, well-planned trade. It goes against you. This part is normal. Every trader faces losses, but something inside starts to shift. Phase 2, the emotional hijack. Your brain's limbic system, the emotional center, starts flooding your prefrontal cortex with stress chemicals. Cortisol spikes, your heart rate increases, your vision literally narrows. This is called amygdala hijacking, and in this state, you're not capable of rational decision making. Phase 3, the revenge fantasy. Now comes the dangerous part. Your brain starts crafting a story. The market's wrong. I know it's going to reverse. If I just double down, I'll make it all back and more. This isn't analysis. This is your wounded ego demanding revenge. Phase 4, the point of no return. This is the F it moment. All your rules go out the window. Position sizing, stop losses, risk management, none of it matters anymore. You're no longer a trader. You're a gambler with a vendetta. Phase 5, the destruction. What happens next is predictable. Either you lose immediately and destroy your account, or worse, you win, which reinforces the destructive behavior and guarantees an even bigger blowup later on. Now let me show you exactly how this plays out in the real world. Let me tell you about Mark, a 36-year-old day trader from Chicago. Mark wasn't some rookie. He'd been grinding for 3 years, pulling in about $80,000 annually from his $90,000 account. Steady, boring, profitable. His wife trusted him. His kids were proud that daddy worked from home. But one Tuesday morning in March, everything changed. Mark had his routine down cold. Scan the markets at 8:30, identify setups by 9:15, and execute his plan. That morning, the NASDAQ futures were showing weakness after a disappointing tech earnings report. Mark's system said go long, but he hesitated for just 5 minutes while he grabbed coffee. In those 5 minutes, the NASDAQ ripped about 50 points higher. Mark watched his perfect setup evaporate. He calculated what he would have made, $4,200. Easy money. Gone. FOMO set in like a poison. When the first pullback hit, a measly 8-point dip, Mark convinced himself that this was his chance. But instead of his usual 2-contract position, he went with 5 contracts. It's gotta bounce here, he told himself. I never get these setups wrong. The NASDAQ didn't bounce. It fell through his entry like it wasn't even there. Mark's brain started doing backflips. This is impossible. The RSI is oversold. The volume is drying up. It has to reverse. So he doubled down. 10 contracts now, all long. His entire day's risk limit blown in one click. But the market kept falling. Mark's P&L was bleeding red. 8,000 down, 15,000 down, $25,000 down. And that's when it happened. The F it moment. Mark later described it as, I saw those red numbers and something inside me just snapped. It wasn't about the money anymore. It felt like the market was personally attacking me, like it was laughing at me. I remember actually saying out loud, F you, market, and slamming my mouse to buy 20 more contracts. At that point, Mark wasn't looking at the charts. He wasn't managing risk. He wasn't even trading. He was in a primal rage trying to fight the market with borrowed money. The NASDAQ continued its descent. Within an hour, Mark had lost $45,000, exactly half of his account. But here's the part that haunts him most. His system had been right all along. 20 minutes after his final revenge trade, the NASDAQ found support exactly where his original analysis predicted. If he had just taken his original long position and managed it properly, he would have made $3,000. Instead, he lost $45,000. Mark later said, "I sat there staring at my screen with my head in my hands. My wife came in asking about lunch, and I couldn't even look at her. I had to tell her that our kid's college fund was cut in half because I just threw a tantrum." Mark stopped trading for 8 months, not by choice. His wife made him. He spent that time in therapy working through what he called the most expensive anger management lesson of my life. That's the effort trade in its purest, most destructive form. A successful trader, a proven system, destroyed in 1 hour by uncontrolled emotion. But here's what's truly insidious about the effort trade. Sometimes it works, and that's when it truly becomes dangerous. Meet Sarah, a 29-year-old swing trader from Austin. Sarah was methodical, disciplined, and consistently profitable for 2 years. She had strict rules, never risk more than 2% per trade, always use stops, never let emotions drive decisions. But October was brutal. A string of well-planned trades hit their stops just before reversing in her favor. By the month end, she was down 15%, her worst month ever. Sarah knew the rules: walk away, reassess, start fresh next month. But she was staring at her monthly P&L, and that 15% loss felt like a personal failure. Her systematic trading friends were posting gains on social media. Her boyfriend kept asking why she seemed so stressed. Then Tesla earnings came up. Sarah wasn't even planning to trade it. Too volatile. Not her setup. But sitting there on that Friday afternoon, down 15% for the month, she looked at Tesla's chart and something shifted. You know what, she thought? I've been too conservative. I've been playing it safe while the big money is made on the big moves. Screw the 2% rule. If I'm already down 15, what's the worst that could happen? She bought $50,000 worth of Tesla calls, 25% of her account, an hour before the earnings announcement. This wasn't analysis. This wasn't her system. This was pure effort trade mentality disguised as boldness. Tesla smashed earnings expectations. The stock gapped up 12% in the after-hours trading. Sarah's calls were worth $78,000 when the market opened Monday. She made $28,000 overnight, not just erasing her monthly loss, but posting her best single trade profit ever. Sarah felt like a genius. She'd unlocked some secret level of trading. Her social media that day? Sometimes you just have to trust your gut and swing for the fences. But that win was psychological poison. It planted a seed that grew into a cancer. Conservative trading is for wimps. The real money is made when you have a conviction and you size up. Over the next 3 months, Sarah's discipline slowly unraveled. She started trusting her gut more. Position sizes crept up. She'd hold losers longer, convinced they'd reverse like that Tesla trade. She'd size up on high conviction plays, which are really just emotional reactions to previous losses. The breakdown was gradual, which made it more dangerous. A few wins here and there reinforced that new approach, but the losses were getting bigger too. The end came in February. Sarah had been stopped out 3 days in a row on swing trades. Frustrated and down $18,000 for the week, she saw GameStop starting to move on some Reddit hype. Without any analysis, without any plan, she threw $40,000 at GameStop calls, telling herself, I deserve a winner after this horrible week. GameStop crashed 30% that day on a regulatory announcement. Sarah's calls expired worthless. But instead of stopping, she doubled down, throwing her remaining $35,000 at GameStop puts, convinced it would continue falling. It bounced 50% the next day. 6 months after her genius Tesla trade, Sarah's $200,000 account was worth $8,000. She hadn't just lost money, she'd lost her identity as a disciplined trader. The Tesla win had rewired her brain to believe that recklessness equaled success. Sarah said, that Tesla trade was the worst thing that ever happened to my trading career. It taught me that my system was wrong, that conservative was weak, and that real traders bet big. I basically spent 6 months on learning everything that made me profitable. That's the insidious nature of the lucky effort trade. It doesn't just destroy your account, it destroys your psychology. A loss on an effort trade teaches you to not do it again. A win teaches you to do it bigger next time. And that's the lesson that will eventually bankrupt you. You might be thinking, okay, those are newer traders. Surely experienced traders don't fall for this. Let me tell you about James. James was a legend, 52 years old, trading S&P futures over 2 decades. He'd survived the dot-com crash, the 2008 financial crisis, and the COVID volatility. He was the guy that other traders looked up to. Steady, disciplined, emotionally controlled. James had developed what he called his boring system. Small positions, tight stops, consistent profits. He'd made millions over his career, not through home runs, but through disciplined singles and doubles. His average trade size was 2 contracts. His average risk was $500. His average monthly profit was $25,000. But December was different. James had hit a rough patch, not unusual in his trading career, but this one felt personal. 7 consecutive stop-outs, not massive losses, just his system getting chopped up in a volatile, directionless market. Each loss was small, manageable, and exactly what his system was designed to handle. But something about the 7th stop-out broke something inside James. He'd been stopped out at exactly the level the S&P then bounced from, for the 7th time. It felt like the market was taunting him, like it was deliberately hunting his stops before moving in his favor. Wednesday morning, December 13th. The S&P had been grinding higher for a couple days, and James' analysis said it was overextended. His system generated a short signal at 46.75. Normally, he'd take 2 contracts, risk 500, make 1,200 if right. But James was angry. Angry at the market, angry at himself. Angry at the string of bad luck. Instead of 2 contracts, he went short 20 contracts, 10 times his normal size. F it, he muttered to his screen. I'm due for a winner. The market owes me. For the first time in years, James wasn't trading his system. He was trading his emotions. And for 2 days, the market went his way. And for 2 hours, the market went his way. The S&P fell from 46.75 to 46.50, a 25-point drop. James was sitting on a profit of $25,000, more than he made most months. But instead of taking profit, which his system would have demanded, James held on. This wasn't about the money anymore. This was about redemption. This is about proving he was right and the market was wrong. This is about getting revenge for those 7 stop-outs. Wednesday afternoon, an unexpected announcement. Something about accelerating the pace of rate cuts. The S&P ripped 50 points and kept going higher. James watched his $25,000 profit evaporate in minutes, but he didn't cut the position. His ego wouldn't let him. This is insane, he told himself. The Fed's making a mistake. The market will realize it and it will come back down. The S&P closed up 50 points from his entry. James' 20 contract short position was now down $50,000. Not only had he given back the massive profit, he'd blown out nearly half of his trading account. 23 years of disciplined trading, millions in profits, a reputation as one of the most consistent futures traders, all destroyed in 1 day of emotional trading. James said that trade wasn't about the money. It was about punishing the market for humiliating me. I literally thought I was teaching the S&P a lesson by refusing to cover my short. I know how insane that sounds now, but in that moment, it felt completely rational. This is what's so dangerous about the effort trade. It doesn't discriminate, rookie or veteran, profitable or struggling. When emotion hijacks logic, experience becomes irrelevant. James knew better than anyone how to manage risk, how to control emotions, how to trade systematically. But none of that mattered when his amygdala took control. The good news? James recovered. It took him 2 years to rebuild, but he came back stronger. He now has what he calls his nuclear stop. If he's ever tempted to size up out of emotion, he literally shuts down his computer and goes for a walk. He said, I'd rather miss 100 good trades than take 1 more effort trade. Now let's dive into why this happens, because understanding the science is crucial to preventing it. Your brain isn't designed for trading. It evolved over millions of years to keep you alive in a world of physical threats. Predators, famine, tribal warfare. The financial markets present challenges your brain has never encountered before. When you take a loss, your brain's amygdala, the fear center, doesn't distinguish between a $1,000 trading loss and a saber-toothed tiger attack. It perceives threat and floods your system with stress hormones, cortisol, adrenaline, norepinephrine. These chemicals have specific effects. They narrow your vision, literally and figuratively. They impair your prefrontal cortex, the part responsible for logical thinking. They activate your fight or flight response. They make you crave immediate action. This is why, after a loss, you feel compelled to do something, anything, right away. your brain is screaming that you're under attack and need to fight back immediately. Here's where it gets really dangerous. When you place that revenge trade, even before you know if it will work, your brain releases dopamine. This isn't the reward chemical, it's the anticipation chemical. It's saying you're about to solve this problem. That dopamine hit feels incredible when you're flooded with stress hormones. It's like a drug. And if that revenge trade happens to work, the dopamine surge is so intense that it literally rewires your neural pathways to crave that experience again. This is why traders who win on effort trades become addicted to them. Their brains have learned stress plus big risk equals big dopamine reward. Your brain also has a quirk called loss aversion. Studies show how we feel losses about 2.5 times more intensely than equivalent gains. Losing $1,000 hurts more than making $1,000 feels good. When you're down on a trade, your brain starts doing mental gymnastics to avoid accepting the loss. If I just hold a little longer, if I add to the position and then average down, the market has to turn around eventually. This isn't rational analysis. It's your brain desperately trying to avoid the psychological pain of being wrong. Here's the deepest level. Your brain links trading losses to personal identity. A losing trade doesn't just mean you lost money. It means you were wrong. You're not as smart as you thought. You're a failure as a trader. The effort trade is often an attempt to salvage your identity. I'll show this market that I'm not wrong. I'll prove that I'm still a good trader. But of course, this approach virtually guarantees the opposite outcome. When you're in this emotional state, your brain is using so much energy to process stress and emotion that it has very little left for complex tasks like risk calculation, probability assessment, and strategic thinking. This is why traders in the middle of an effort sequence make obviously bad decisions that they'd never make in a calm state. They're literally not thinking clearly. Their brains don't have the capacity. The key insight is this: you cannot think your way out of an amygdala hijack. Logic and willpower are useless when your brain is flooded with stress chemicals. Instead, you need systems, rules, and environmental changes that work even when your brain is compromised. We'll cover exactly how to build these systems in the next section. Now, I'm going to give you a complete system to immunize yourself against effort trades. This is a battle-tested framework used by professional traders to maintain discipline under pressure. Level 1. Early warning systems. First, you need to recognize the warning signs before you reach the effort moment. Some of the physical signs: increase in heart rate, jaw clenching, shallow breathing, tense shoulders, fidgeting with the mouse or your keyboard. The mental signs: thinking, I need to make this back, calculating how much you're down for the day or for the week, feeling personally attacked by the market, making excuses for why your stop loss is wrong, fantasizing about big winning trades. Now the behavioral signs: checking your P&L more frequently, increasing position sizes gradually, holding losing trades longer than planned, taking trades outside of your system, and checking social media for validation. Now level 2, circuit breakers. These are automatic rules that kick in when warning signs appear. The 3-strike rule: 3 losing trades in a row, stop trading for the day. No exceptions, walk away from the computer. The 2% daily loss rule: down 2% on your account for the day, trading is over. This prevents small losses from becoming account killers. The emotional check: before every trade, rate your emotional state from 1 to 10. If you're above a 7, no trading allowed. The mirror test: literally look at yourself in your phone camera before placing any trade after a loss. If you see anger, frustration, or desperation, stop. Level 3, environmental controls. Change your environment to make effort trades harder to execute. Remove easy money access. Don't keep all your trading capital in one account. Put 70% in a savings account that takes 24 hours to transfer. You can't make effort trades with money you can't access. The 20-minute rule: after any loss, close your trading platform and set a 20-minute timer. Do not trade until this timer goes off. This gives your brain time to clear the stress chemicals. Physical barriers. Some traders literally put their mouse in a drawer after losses, forcing themselves to make a conscious decision to take it out. The phone a friend system. Have someone you must call before making any trade larger than your normal size. Make them ask, is this revenge trading? Level 4, cognitive reframes. Change how you think about losses and the market. Losses are tuition. Every loss teaches you something. You're not losing money, you're paying tuition to the market university. The market doesn't know you exist. The market isn't personally attacking you. It's a neutral force responding to millions of participants. Taking losses personally is like taking rain personally. Professional risk manager identity. Start every trading day by saying, I am a professional risk manager who happens to trade, not a gambler who happens to manage risk. The long game perspective. Ask yourself, will this trade matter in 5 years? Usually the answer is no, which puts the urgency in perspective. Level 5, replacement behaviors. When you feel the urge to revenge trade, do this instead. Physical release, 50 push-ups, a cold shower, or a 10-minute walk. Burn off the stress chemicals through physical activity. Journal the feeling. Write down exactly what you're feeling and why. Often articulating the emotion makes it lose its power. Review your why. Read your trading goals. Remember why you started trading and what you're trying to achieve long term. Success visualization. Spend 5 minutes visualizing yourself as the disciplined trader you want to be. See yourself following your rules and being proud of your discipline. Level 6, the nuclear option. For traders who have blown accounts before, you need the nuclear option. Automated shutoffs. Set up your brokerage account to automatically prevent trading if you lose more than X amount in a given day. Accountability partner. Give someone else the ability to shut down your trading account. This could be a spouse, a friend, or a personal trading coach. The 72-hour rule. Any significant loss, define this beforehand. You cannot trade 72 hours. No exceptions. This prevents the cascading effort trades. Remember, these systems only work if you implement them before you need them. You cannot build discipline in the middle of emotional chaos. Let's talk about something most trading educators won't tell you. The effort trade isn't really about money. It's about identity. When you take a loss, your brain doesn't just register financial damage. It registers identity damage. I'm supposed to be good at this. I'm supposed to be smart. I'm supposed to be in control. The effort trade is almost always an attempt to restore your identity as a good trader through one big win. But here's the paradox. The very attempt to prove you're a good trader through reckless behavior proves you're not. Real professional traders have a completely different relationship with losses. They expect them. They budget for them. They learn from them. A loss doesn't threaten their identity. It confirms they're taking appropriate risks. Start thinking like a casino owner instead of a gambler. Casinos don't care if they lose money on an individual hand of blackjack. They know the odds are in their favor over thousands of hands. Professional traders think the same way. Ironically, trying to control your trading outcomes through effort trades is the fastest way to lose control. Real control comes from accepting that you cannot control outcomes, focusing entirely on controlling your process, and measuring success by rule following, not profit. Every effort trade is a choice. Do you want to protect your ego or protect your equity? You cannot do both. Your ego wants to be right. Your equity needs you to be disciplined. Here's your step-by-step implementation plan. Week 1, install the warning systems. Start tracking your physical and emotional state before every trade. Week 2, implement the circuit breakers. Set your daily loss limits and 3-strike rules. Week 3, set up environmental controls. Move excess capital out of easy reach. Week 4, practice the replacement behaviors. When you feel the effort urge, use physical activity and journaling. Week 5, begin the identity work. Start each day by affirming your identity as a professional risk manager. Month 2, refine and optimize. See which techniques work best for you personally. Lastly, the ongoing phase. This is for regular review and adjustment. Your anti-effort system should evolve as you do. The effort trade is where accounts die. It's where careers end. It's where dreams get crushed. But it doesn't have to be your story. Mark lost half his account and nearly quit, but he came back stronger after learning to manage his emotions. Sarah won big and lost everything, but she rebuilt her discipline and now trades more consistently than ever. James had 23 years of success nearly destroyed in 1 week, but he recovered and now helps other traders avoid his mistakes. You have something that they didn't have when they faced their effort moments. You have this knowledge. You understand the psychology. You have the tools. You have the system. The market will test you. There will be days when everything goes wrong, when your stops get hit, when you feel like the market is personally attacking you. In those moments, remember this video. Remember that discipline always wins in the long run. Your future self, the successful, consistent professional trader you're becoming, is counting on the decisions you make in your darkest moments when that effort feeling rises up, when your ego demands revenge, and when that little voice whispers, just one more trade. Remember who you're becoming and choose discipline over destruction. The market doesn't punish you for being wrong, it punishes you for being reckless. Choose to be professional. Choose to be disciplined. Choose to be successful. Your trading career and your financial future depends on it.